Hello and welcome. You're with us here on Business Today. I'm Abha Bukaya. Here are the headlines. Banks start hiking loan rates a day after RBI's repo rate increase. ICICI and Bank of Baroda first off the block. Our experts tell you whether it's time to convert your home loan to fixed rate. Volatile day at Dalal Street. Indices end flat after jumping 1.5% in trade. Twin rate hikes by the RBI and the US Fed discounted. Big relief coming in for consumers. Government planning to cut taxes on edible oils to cool surging prices. Government may cut import duties on oil to 5% from 35% to help boost domestic supply. LIC IPO sees strong demand, issue fully subscribed. Policyholders quota subscribed over 2.7 times on day 2. IPO will remain open even on the weekend given the large amount the government is looking to raise from the market. Central Bank of India to shut down as many as 600 branches. Report says the bank is looking at selling non-core assets to improve its financial health. Tata Motors now electrifies the commercial vehicle market, launches the country's first e-truck, Ace EV, to hit the market next quarter. Less than 24 hours after the RBI hiked the repo rate by a surprise 40 basis points, loans have already started getting costlier. ICICI Bank was the first off the block with a 40 bips hike, increasing its base lending rate to 8.10%. Bank of Baroda also increased its rates by a similar amount to 6.9%. The hike will increase EMIs for those with floating home loan rates. It will also raise the cost of borrowing for those taking fresh home, auto and personal loans. On the flip side, the rate hike will benefit those investing in FDs. Banks are always a little slow in raising their FD rates. ICICI Bank has currently done so only for deposits of over 2 crore rupees. Most banks have a base lending rate often referred to as the MCLR. My colleague Sakshi Batra explains what it is and how it impacts you.
Well, that's right. The days of low interest rates are over and loans are all set to become dearer as the RBI has raised the repo rate by 40 basis points, and this means higher EMIs for you because your loans today are linked to the MCLR. So what exactly is the MCLR? Let's begin to understand that first. MCLR is the marginal cost of fund-based lending rate, and this rate was introduced by the RBI or the Reserve Bank of India in the year 2016. It actually ensures faster transmission of rate changes, and also the MCLR is the minimum rate of interest benchmarked by a bank below which any bank cannot lend. So what is the importance of this MCLR? That's something that you must understand. Well, for one, it is linked directly to the repo rate, which is set by the RBI. Now, most banks peg loan rates to this MCLR. Any hike in the MCLR actually increases the interest rates for you. And these rates will actually rise both on the loans part and on the deposit rates as well. So while on the one hand borrowers may feel the pinch, depositors will actually enjoy higher rate of interest. Now, which existing loans will be hit because of RBI's rate hike of the repo? Well, while all the fresh loans will start to cost more due to increased cost of borrowing for banks because of this repo rate hike, home loans with a floating rate will actually immediately feel the hit. Also, loans against property will feel immediate impact of this repo rate. However, RBI's latest announcement will actually not impact the existing borrowers of fixed rate of loans on auto loans as well as personal loans. Now, what will be the impact on your EMIs? That is something that you must understand absolutely. Say you have a 20-year home loan of say 10 lakh rupees. Now, a 20 bips hike will actually push your monthly EMI by 120 rupees. 30 bips hike will increase your EMI by 180 rupees. A 40 bips hike on this will actually lead to an increase of 240 rupees on your EMI, on your monthly EMI, and a 50 basis points hike will actually push your EMI by 310 rupees. Now let's talk about the auto loans as well and the EMIs, how those will get impacted. Say you have a 5-year auto loan of 10 lakh rupees. Now a 20 bips hike on the MCLR will push up your EMI by almost 100 rupees. A 30 basis points hike will actually push your EMI by 146 rupees. Another 40 basis points hike will actually lead to an increase of your EMI, monthly EMI by 194 rupees, and a 50 basis point hike will push your EMI by 242 rupees. And not just that, one should also be prepared for further rate hikes, as this may not be the only rate hike that RBI will do.
A question everyone is asking is, will their home loan EMI rise? We go a step further and tell you whether it's time to shift to a fixed rate home loan from a floating rate home loan. My colleague Sakshi Batra spoke to Bank Bazaar CEO and co-founder Adil Shetty. Here's a part of that interview.
What should the existing home loan borrowers now do who have a floating home loan rate? Is it better for them to switch to a fixed rate? Perhaps to save on the upcoming rate hikes? Now we all understand that this could not be just one rate hike that the RBI has done. Because of the macro setup, there could be more coming in. So what's the best option for them?
Yeah, great question, right? Now, I wouldn't go down the path of shifting to a fixed rate. The reason being that a fixed rate loan is typically, 0.5 to 3% higher. It's not something we typically recommend. But I want to recommend two things to the floating rate home loan borrower. So the first thing, right, is a technique which we call prepayment in terms of reducing the EMI outflow. So I'll just give you an example.
Okay.
Now, because the rate has gone up by 0.4, you're paying 18 extra months EMI. Now, there's a small rule of thumb we advise at Bank Bazaar. If you prepay 5% of your outstanding principal every year, a 20-year loan can be paid off in 12 years. So in the same way that a rising repo rate increases the tenor of your loan, EMI staying constant, every time you prepay, your tenor keeps coming down. So maybe you can't prepay 5% of outstanding every year, but even prepaying one EMI a year, right? Or whatever you can prepay when you get a bonus, automatically will reduce the tenor. So it's the opposite effect of a repo rate increase is a prepayment. So this is strategy number one. Strategy number two, right, is today there are a lot of special offers for people with credit score over 750, credit score over 800. So you can get a 0.1%, 0.2% discount. So if you're someone who maintains a high credit score, you can always look to refinance your loan, getting these special offers for people with credit score over 750 or 800. So these are the two things I recommend existing home loan borrowers on floating rate do.
In yet another volatile session, benchmark equity indices trimmed gains after rebounding from yesterday's lows and settled flat. This even as the Fed's move to hike the key interest rate by an expected 50 basis points soothed nerves of global investors. Sensex wiped off 800 points from the day's high and settled at 55,702. Nifty also shedding 250 points from the day's high to close flat near 16,700. Meanwhile, even the broader markets continue to disappoint. Among sectors, IT, metal, autos logging in gains, while we saw selling in real estate, healthcare and FMCG stocks. Tech Mahindra, Hero MotoCorp, Infosys, HCL Tech and Tata Steel, some of the top gainers in trade today. Some relief may be in sight for consumers who are reeling under the skyrocketing prices of edible oil. The government is planning on cutting taxes on some edible oils to cool the domestic market. According to reports, India is looking to cut the agriculture infrastructure and development cess on crude palm oil imports from 5%. The new tax amount is still being deliberated. The government is also looking to cut import duties on crude varieties of some edible oils to 5% from 35% to help boost domestic supply. The war in Ukraine and ban on palm oil exports by Indonesia has led to a sharp spike in prices of edible oil in India. One of the leading PSU banks is reportedly embarking on a major cost-cutting spree. According to news agency Reuters, the Central Bank of India is looking at shutting down 600 branches. This constitutes 13% of its entire network. The bank is looking at either shuttering or merging its branches to cut costs and improve its financial health. The report claims the bank will also sell some of its non-core assets like real estate. The spate of fires, in some cases deadly, in e-scooters have hit sales in April. Figures released earlier in the day show overall EV sales dipping by more than 6% after an exponential rise over the last year. Sales of e-scooters and other high-speed two-wheelers were down about 1%. The figure, however, rose more than 9 times over April 2021. The top 5 brands by sales in the electric two-wheeler space in April were Ola, Okinawa, Hero Electric, Ampere and Ather. Meanwhile, e-car sales fell substantially, around 25%, owing to a shortage of chips as well as issues related to a lack of charging facilities. Tata Motors remained the biggest player with 87% market share. Tata Motors already enjoys a massive 87% market share in the passenger EV market, and now the company is all set to launch the country's first electricity-powered truck. Tata unveiled the electric version of its popular mini truck Ace. The e-truck will hit the roads next quarter. The company claims the truck can run more than 150 kilometers on a single charge. Tata has already received orders for 39,000 trucks from Amazon, Big Basket, Flipkart, among other companies. My colleague Chetan Butani caught up with Girish Wagh, Executive Director at Tata Motors.
Tell us about when will this product hit the market and what will be the range, the charging capabilities, the intercity, and especially the abuse testing that really needs the electric vehicle system scenario in India. How are you going to manage that entire ecosystem now?
Right. So the vehicle should be commercially available from the next quarter. In terms of validation, testing, design, I think we have done it considering the tropical climate conditions. So we have been working on it for more than 2 years now, and a lot of actual operating conditions have been used to define the duty cycles for validation of the vehicle. So I think from that perspective, the product as such is very well ready to address the requirements of this segment. In addition to this, the range is going to be 150 kilometers as per AIS 040, and in addition to that, it comes with slow charging as well as fast charging option. So the fast charging option gives you good amount of range increase by charging it for just 45 minutes during the day. And the slow charging is something which one can do overnight for the home charging point, and therefore you are ready to go next day. So I think with all this, we should be in a position to give very good operating range, very high cubic space as compared to the current vehicles that are available for last mile cargo distribution. So I think overall a very good solution from product point of view. To back it up, we will have a very robust support center, support solution, wherein we will track the vehicles fully for battery health, vehicle health, how is it being used and so on and so forth, using our Fleet Edge telematics solution. And that will give us an opportunity to track the vehicles proactively, give inputs to the customers, and finally therefore ensure the highest run.
Meta Platforms, the parent company of Facebook, is set to open its first physical store. Shoppers will be able to try out and buy virtual reality headsets and other gadgets. This comes even as the company plots a course to take its highly touted metaverse mainstream.
For tech geeks, it's a paradise come true. The 1,550 square feet Meta store at the company's Burlingame campus in California opens this Monday. The company says it will feature demos for its Quest 2 VR headset and video calling device portal, as well as smart glasses as it produces with Ray-Ban. The devices, except for the Ray-Ban glasses, will be available for purchase at the store. The products can also be bought online through a new shopping tab on meta.com. Meta is investing heavily in the metaverse, a virtual space where people interact, work and play, by adding new features to hardware devices that serve as access points to the virtual world. Last month, the Facebook owner said Meta would start testing tools for selling digital assets and experiences within its virtual reality platform Horizon Worlds, a VR platform Meta launched late last year. However, in a move that has attracted criticism from some app developers, Meta said it would charge a whopping 47.5% fee from creators of digital experiences and assets. Bureau Report, Business Today TV.
Let's welcome in our global business editor Udayan Mukherjee and get started on those queries. We hope you're sending in your query on the number on the screen. We take a few select queries every Wednesday. Our first query, we've got Anand from Nainital, and he has a query on Huhtamaki India. Let's listen in.
Hi, this is Anand Sharma here from Nainital. I have a query for Huhtamaki India Limited. I am holding 500 shares of it and expect reasonable returns. And I can hold it for 8 to 10 years. So my question is, do you think it can deliver 18 to 20% returns in 8 to 10 years? And if not, are there better options? Please suggest. Thank you.
Well, Huhtamaki is not a bad company. I mean, as you know, having invested in it for the long term, it's a flexible packaging maker, and it has good pedigree because it's now owned by a Finnish parent, Huhtamaki. 18 to 20% stock price growth over 10 years is not an easy task, though Huhtamaki is growing at 18-20% in terms of revenues. So it's a strong player in flexible packaging. The problem with Huhtamaki right now is, and that's the reason the stock has corrected quite significantly of late. I mean, actually it halved from 320 to 150 and has bounced back to 190, 200 again. So it had a really gut-wrenching period over the last few months. And partly the reason is because of the kind of results it's been declaring. As I said, it's declaring 18-20% revenue growth, but it's still making losses for the last 3 quarters running. That is quite unusual for a company with reasonable growth, and that's because its margins have collapsed. Because of the rise in the price of crude and raw materials for Huhtamaki, basically operating margins have collapsed to close to 1.5%, wafer thin, and therefore the company is just not able to report profits for the last 9 months, and the stock is taking a beating. So it still looks like, given its client profile, a reasonable long-term play, but I would be a bit cautious in the near term, because if crude continues to remain this high, then raw material pressures will ensure that Huhtamaki makes no money at all, and therefore the stock will languish. So till there is greater clarity on where the crude cycle is headed, given geopolitical concerns, and where these raw material issues are going to eventually pan out for Huhtamaki, I think in the near term the stock may struggle to perform.
Srinivasa Prasanna has also written in from Bengaluru. Let's listen into this query.
Good evening, sir. I am Srinivasa Prasanna from Bangalore. Currently, I am holding 200 shares of Jubilant Ingravia. Can I hold it for next 2 to 3 years?
Well, Jubilant Ingravia is a reasonable player in the specialty chemicals and life sciences space. And it's one of those players which is basically trying to cash in on the China Plus One opportunity in chemicals. The company's stated ambition is to grow revenues or double revenues every 5 years. So, and top line growth is, to be fair to the company, quite reasonable. Is it the best company in the chemical space, specialty chemical space? Probably not. And I say that because there are a couple of risks which one has to highlight with Jubilant Ingravia, though the management is quite good. Is that nearly half of the company's revenues are in the life sciences space, not specialty chemicals. And in the life sciences space, one of their key raw materials, acetic acid, is going through a fairly significant churn in terms of prices, great volatility in prices. And you know, since this contributes such a significant share of Jubilant Ingravia's profits, the life sciences segment, I think the company is exposed to the kind of risks that I just highlighted for Huhtamaki as well, raw materials eating into the margins. So I'm a little concerned about margins for Jubilant Ingravia in the foreseeable future, so fingers crossed on that. And while I will not suggest specific names, I think if you do your homework in the specialty chemical space, you may just come up with at least 3 or 4 names which have better long-term prospects compared to Jubilant Ingravia. So fingers crossed.
Long-term definitely seems to be the key word here. Now, Ankit Srivastava has written in from Mumbai, and we've also got a lot of queries coming in today from the broader markets. And this one again is for a period of 3 to 5 years. Listen in.
I want to ask Udayan sir about Advanced Enzyme Technology stock. I bought it at ₹300 levels. Can it grow multifold in next 3 to 5 years? Thank you.
You know, potentially yes, Ankit, because it's a great space, the enzymes space, because the enzymes market globally is a $10 billion market. It's huge. And Advanced Enzymes is still a very small player. The problem is that for a space that large and for a company which has got such a tiny market share in the enzyme space, it is just not able to grow that fast, and that is baffling for most investors, because you get into the stock thinking such a big opportunity ahead, the global enzyme space. If one can manufacture in India and sell overseas, the company should become potentially a very large company. Yet it's struggling to grow at more than 10-11% over the last many years. And average growth in revenues for Advanced is just about 10%. That is not acceptable because it's such a small company. For a $10 billion market, Advanced Enzymes top line is something closer to $100 million. So it is really a minuscule player in the global enzyme space, and that's, I think, is the central problem with Advanced Enzymes. The opportunity is there, but the growth is just not strong. And as with most chemical companies, I think it also suffers from some input cost pressures which are squeezing the bottom line. So top line growth anemic, bottom line pressures are there. So I don't know what the answer to your question could be, because the opportunity exists, but whether this is a management which can really cash in on this opportunity, they have not been able to prove that over the last 3 or 4 years.
Bharat Patel from Mumbai has also a query regarding Polyplex. Let's find out what price he bought in to that share and what his query is.
Hi Udayan, I am avid follower of yours since very early days. I have 400 shares of Polyplex Corporation at 125. I am holding since 2008. Now price is around 2,700. What should I do? I intend to hold it for next 5 years. Your views, please.
Well, you're a serious long-term investor, and far be it from me to recommend a switch out for a stock which you've made so much money in. Because not only has the stock gone up from your price of 180 to 2,700 over the last 15 years, even in the last year, the stock has been a three-bagger. It's trebled from its price. So Polyplex has delivered very good returns for shareholders over a long period of time. So the issue is that over the next year and a half, there might be some kind of sluggishness. A, because of the price performance being so strong already, and B, because in the BOPET market, the polyester films market, which is where Polyplex is a giant, and I say giant because it is one of the global leaders in polyester films with manufacturing facilities across 5 countries. It's a global scale player. It's not one of those tiny chemical companies or packaging companies which are seeking to become big. It is already a very large player. But in the BOPET market, in the polyester films market, periodically it's a cyclical kind of a play. Sometimes supply will come in globally, and in years when there is a lot of supply, the prices tend to slacken, and therefore the margins come under pressure. I think we're going through that kind of a phase in BOPET, where there is a lot of global supply which is kicking in, and prices may remain slightly subdued for a period of 18 to 24 months. If that is the case, then Polyplex will not be able to grow its profits very significantly. But it's not an expensive stock. It's just early to mid-teens kind of a PE multiple. The issue is of oversupply for the moment, and therefore if you're willing to look through it as a long-term investor, as you seem to be, then I think in the longer term you should still be fine with Polyplex. Just don't expect the kind of returns that you've made over the last 1 year in the next 12 months or so.
All right. That's all we could pack into this edition. Udayan, thanks so much for taking out the time and answering all of our viewer queries. If you have some queries, do send them in to the number on your screen. We'll take a select few every week.